Hello and welcome to Hot Money on Bloomberg Mint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our guests for the day. Joining us today are Sharmila, Joshi and Vivek Mavani. Both of them are independent investment advisor. And Sangeet Lakkar of Newberry Capital also joins me on the show. Many thanks to all of my guests. Today on Hot Money, we'll discuss Tata Chemicals. Tata Chemicals is recovering from a 52-week low. Is it the right time to start accumulating the stock? Vodafone Idea is something that we want to talk about. Is it worth the investment post the rights issue? We will focus on the utility space because companies like NTPC and Power Grid again are moving up, and we check whether analysts are willing to bet on this space. And we ask our analysts for their top pick of the new financial year. Today is the 1st of April. We'll ask what they believe could be the new bet that they are betting on this time around. The first stock obviously is Tata Chemicals. Again, Tata Chemicals is interesting because being a chemical company, the focus towards the consumer business has been slowly and steadily increasing. No doubt it's a very small portion of their entire revenue, but does this change that once this goes on becoming much better and much bigger? Does the valuation multiple change for Tata Chemicals? That's something that we want to ask on. So Vivek, I'll start with you. Tata Chemicals, what do you make of it? Do you believe that the foray will be strong? Will they be able to garner that share in the consumer space, or what's the sense that you're getting?
A very interesting story in Tata Chemicals building up. So I'll just continue with the point which you mentioned, that today the consumer part, where they are from what used to be Tata Salt, the branded product, a single branded product for more than 20 years, to now they have an entire bouquet of products in food grains, cereals, pulses, spices. So I mean, they also got into basmati rice and dals and all of it, including spices. And obviously that product portfolio continues to expand practically every quarter with a couple of new products adding. And it's a play on distribution network where they are fairly strong in terms of reaching out to provision stores, kirana stores, general trade, including the modern retail, the likes of D-Mart and Big Bazaar and so on and so forth. Now, it may be small in relation to the total consolidated Tata Chemicals, but it's clocking something like 470-480 crores per quarter in terms of sales. I mean, 475 crores was the most recent, that is December quarter, and growing every quarter in the vicinity of 15 to 18%. So what we are talking about is, for the next year, we are talking of something like sales of 2,100 crores in terms of top line for the consumer business alone. This, by the way, and this earns about 12-13% EBIT margins, not EBITDA, EBIT margins, earnings before interest and tax. And it's a negative working capital business. It actually requires no working capital. I mean, and this I'm going by the segmental reporting that the company does. I have not done any further analysis in terms of either their interest or their capital employed and so on and so forth. So it's a classic FMCG business, growing in double digits, earns double digit margins, negative working capital. So you have actually return on capital which is excess of 100%. Now, if this business was standalone listed, it would probably have, I mean, going by other FMCG companies with similar dynamics, probably a market cap of no less than 7,000 to 8,000 crores. Again, a rough estimate with surplus cash on the balance sheet as well. Now, a market cap for the assumed market cap for the consumer business at say about 7,000 crores. The whole of Tata Chemicals is available at 15,000 crores, which includes their domestic soda ash business, sodium bicarbonate business. I mean, this international chemicals business plus holdings in Rallis and miscellaneous other businesses, which are investments made over a period of time. So, for the balance of the core chemicals business, which is cyclical, which is a commodity business, it has deep value. Now the point, now coming back to the key question, would I buy it? Would we accumulate? At some point of time, Tata Group would look to demerge this business and put it together with Tata Global Beverages or Tata Coffee, the domestic business of Tata Global Beverages / Tata Coffee, because that's where there are serious distribution synergies. There are synergies on branding and marketing and so on and so forth. So that could be the big trigger over a period of time. Now, we don't know whether it's going to happen in the next 1 year, 2 years or 5 years. We really don't know. Tata Group itself has never mentioned of any kind of demerger or alignment of the consumer business all within one umbrella, but it logically makes sense. That will be the big trigger. So one has to take a long-term view, perhaps a 2 to 5 year view for this event to play out. Otherwise, I'm not really enthusiastic if this event is not happening.
Okay, so it's a 2 to 5 year view that Vivek speaks about. Sharmila, what's your sense on Tata Chemicals?
Yes, so I think, where the numbers are concerned, we have seen that this quarter was muted, and last couple of quarters too, the results have been patchy. But the company has sort of maintained that this is because of one-offs, and I think it is pretty clear that there have been different pockets of the business globally where there have been problems, and hopefully you could see some recovery in that. So I think that is one reason to be sort of reasonably positive about the stock. And I would completely agree. I think the domestic business, both their chemical business as well as this consumer business, is doing reasonably well. Tata Salt, they still have the sort of the largest market share, and their whole pulses and spices portfolio is also growing very nicely, I would say. So yes, I think you don't have to look at this. The problem with Tata Chemicals is the valuation that it gets is largely to do with the soda ash business. So you're looking at it as a chemicals, that soda ash sort of tag on it. You're not looking at it as a FMCG. You're completely ignoring that FMCG bit in it, as well as their investments in other companies and all that. So I think it is time to accumulate, and you really have to look at the stock as a sum of parts kind of business, even if they don't do the demerger. And I think you should reasonably see a price of at least 10-15% higher than where it is today.
Okay, Sangeet, what's the sense that you're getting on Tata Chemicals?
I'm pretty neutral to Tata Chemicals actually. So I think the guests have spoken about the business as such. Now, if you see the valuations bit, still 70% of the turnover comes from the commodity business, and you can't value the commodity business more than 5 times EV by EBITDA, which is the global practice, and which is even in India the listed peers trade at same valuation. And the consumer business which is there, 50% of it is coming from salt, which is again a matured product. Even if you give 3 times sales, and I'm talking about 3 times sales, which comes to about 6,000 crores valuation to the consumer business, and 5 times EV EBITDA to the commodity business, and with a 30% holding company discount to Rallis at the current market cap, it still trades at about, current market cap is around 15,000 crores, and if you do this SOTP valuation, it comes to about 14,000 crores or sort of. So I think it's fairly valued. We'll have to see the next triggers, if any. But at the current price, I'm not a buyer as such.
Okay, that's the sense that you're getting in on the first stock, and that is Tata Chemicals. The second stock we want to talk about is Vodafone Idea. Again, post the rights issue, it's trading at close to 18 rupees per share right now. Somehow, the market's not too enthusiastic as far as this entire deal is concerned. Again, problems coming in because of the expansion that we've seen in Jio, Bharti, Airtel, despite Vodafone Idea being the largest as far as the customer is concerned. Does it make sense for you to start accumulating Vodafone Idea? The price point is on the cheaper end. I'm not sure about the valuation, but that's something that we'll ask for. Sharmila, would you buy Vodafone Idea?
Yeah, so I would agree with you on the price point, that in that sense it, the level I started sort of not liking the stock was when it was in its 30s, 34, 35, and from there we've seen it come to 18. So maybe from that perspective it's all right, and it has some positives going for it. But I think that net this rights issue is going to be an overhang for them to get out of, because at the end of the day, the pricing that they've done it at, and it seems to sort of suggest that the investments from both Vodafone and Idea end will come at that price. So what I'm trying to say is that it will be very difficult for them to really justify a much higher price immediately. So I think it's going to take some time. They're going to have to do the investments. They're going to have to show those couple of quarters of sort of decent growth, and then maybe they can take it from there. And I think in the meantime, the competition from Jio is really hotting up. I think that both Airtel as well as Vodafone Idea are really going to feel the pressure going ahead. So it's a very, very fluid situation. So as of now, I'd still completely avoid it.
Would you play anything in the telecom space?
If you have to play anything, according to me, it would be Reliance on the back of Jio. I wouldn't play either.
Okay. Sangeet, what's the sense you have on the telecom space and Idea?
I have been positive on telecom space, and though I prefer Bharti over Idea, but I am still a buyer on Idea as well.
Okay.
So I look at the things a little differently. First of all, the current price that you're seeing is after rights adjustment.
Yeah.
So technically, it's still trading at sort of 30 bucks if you consider, before rights. Now the promoter has committed to infuse about 18,000 crores. It has also committed that in case of any shortfall of rights, it's ready to put in more. Now that's a big commitment to make. I also see telecom player as being a 3-player market for the next 10 years probably. I don't see a 4th player coming in very soon. Now the only issue remains when the pricing goes up. I think we are right now at the bottom of the ARPU. Globally, world over, there has been no precedence of such ARPU sustaining for a long time. Sooner or later, we'll be seeing, the three operators colluding and, coming to a rational pricing strategy. And once that happens, you'll see a fair amount of operating leverage which will come into the numbers. The only question about Vodafone Idea was, amongst the three players, Vodafone Idea was most susceptible to closure because of their debt levels. Now with the rights issue and with their monetization of some assets, including Infratel stake sale, I think they are sort of out of that kind of a risk. So if they are able to sustain this patch, I think they'll make big amount of money going forward.
Okay, you're positive on this space. So what would your pecking order be in this space?
Bharti Airtel and then Idea.
Okay, not Reliance. You won't play Reliance as a proxy play to Telecom?
But Reliance, again, it's more of the oil and gas play as of now. Once the Jio gets listed separately, we'll have to look at that juncture.
And what makes you positive on Bharti Airtel?
So Bharti is, because of the debt levels and because of the Africa business, Bharti is kind of little immune to the domestic price wars, So as compared to Idea, it's a little safer bet, I would say.
Oh, that's the sense that you're getting on this. What about you, Vivek, on the telecom space and Vodafone Idea?
Well, we have spoken about telecom, including Bharti Airtel and Idea on this very program earlier also. So I continue to stay negative, and it's basically a larger call on three aspects. I agree with Sangeet about shakeout has happened. The market is, the telecom business is consolidated between three large players, all of whom have about 30-35% between them. So it's one third more or less in terms of subscriber base. But in spite of the consolidation, it is actually Reliance Jio which has been over the last 2 years calling the shots in terms of pricing, and Vodafone Idea and Airtel have just been forced to follow that in a bid to protect their subscriber base. The telecom business itself is going through, not just in India, globally, where voice, data, entertainment, e-commerce, everything is merging into a single infrastructure. And there, of course, in India, Jio has been leading that. Airtel is catching up, but Vodafone certainly, clearly is a laggard in terms of trying to capture revenues from non-voice, non-data. The other ancillary businesses, which today may look small, but are growing by leaps and bounds in terms of the usage of the mobile network in India. Even after this fund infusion, what Vodafone Idea would get is the business still loses money every quarter and likely to lose in the foreseeable future. Even the management has probably prepared the market and guided for losses. But even after this fund infusion, what really happens is they have some more firepower to fight back and protect their business. That's one. But even post all that, and even if I were to take Sangeet's argument that, okay, in terms of pricing, we have probably hit the bottom and from here it can only go up. Well, even if it were to go up, can Vodafone and Idea have a business which generates at least double-digit margins and a double-digit return on capital, return on equity subsequently? Whether it's 2 years later, 3 years later, I don't know. But whenever, any time in the foreseeable future, and I don't see that. That's my personal opinion, that this business any time in the future is unlikely to generate double-digit return on capital or return on equity. Now, that's my preference in terms of the stocks I invest in or trade in, that the companies which don't pass that filter. So for me, it's a clear avoid. It's okay to trade in a range that, okay, you've bought at 18 and sold at 21 and those kind of trades. But from an investment merit point of view, I don't really see anything in telecom to play for. Reliance Jio, yes, at some point of time you could be, there could be a big trade on demerger, and but meanwhile, it's a Jio which is creating the excitement in Reliance, although 95% of the profits come from the core oil and gas and petrochemical business, which is what generates also the cash flows that sustains the investments in Jio.
Okay, so that's the sense that we're getting in on Idea, Vodafone and the telecom space. Sangeet, however, likes the telecom space, but he prefers Bharti Airtel over Idea, but not too much positive views coming in. as far as Vodafone Idea is concerned. The next one we want to talk about is the utility space. You've seen a lot of positive triggers that came in, at least in terms of the new CERC orders that came in, that caused stocks, at least in the telecom, in the utility space, to go up. NTPC went up, Power Grid went up, JSW Energy is moving up because of not foraying too much into the electric vehicle segment, given the fact that they don't believe it's sustainable. But overall, on the utility space, is there something that our guests like at this point of time? Sangeet, anything in the utility space that you've recommended to your clients?
So I like the power generating companies as against power distributing companies, which are, even though they are asset light, but they are very well regulated by the government. So amongst the power generators, I like JSW Energy. I think the entire sector has gone through a turbulence over the last 10 years because of excess capacity. And now we have seen over the last 2 years where power demand is growing at about 7 to 8% and the capacities are not getting added because of the NPMS and whatever we have seen. In this scenario, you have to choose the stronger players with leaner balance sheets, and JSW Energy fits into that. It's trading almost at book value. I don't see capacities getting added in this sector so rapidly till the time utilization go up. And if you see the PLFs also, they have been inching up for JSW Energy and for the sector as such. It also has an exposure to merchant sales as well as the long-term power purchase agreement. So the merchant power being over last 3 to 6 months being on the uptrend, that also gives a little bit of earnings kicker. And they have consistently deleveraged their balance sheet over the last couple of years. So you will have operating leverage as well as financial leverage playing out in the numbers. So I like JSW Energy.
Okay, that's the sense. What did you make of this news in terms of not foraying into electric vehicles any further that came out? Is it a positive?
So I would sense so, because they were entering into an uncharted territory, and as a shareholder, I would like businesses to focus on their core business. So I would take this as a positive.
Okay, what about you, Sharmila? Anything in the utility space?
No, not terribly excited, because I would, in fact, the only stock that I've really recommended over the last 2 years is JSW Energy, and that's sort of at the price that it was when I recommended it. So it's not gone anywhere, which is also a positive, I think, in a market like this. But I think, the problems for power sector are too many, and there are too many levels. Apart from the whole NPA picture and the fact that, I don't know what, some big number of 1.14 lakh crore some MPAs in the sector. I think apart from that, it is as I said, at whether you're at the generator level or whether you're somebody selling the power, or I think it's just there are problems at every level, and you need a very, very different sort of an approach and a more holistic approach to really solving the issues within that sector, and we're still not getting that. So I think for me, it's an avoid.
What about you, Vivek? Anything that you've recommended to your clients or personally taken position in the utility space?
So there it was CSC, but CSC also not so much for the utility business that I am excited about, but it was about the demerger of the retail business and their investments business, CEC Ventures, all of them, which were listed in January. Now, as far as the power and the utility space is concerned, it's been almost 10 years that the sector has been out of favor. Very few market participants really interested in, and rightly so, because it's been it's just been bogged down with too many problems, as Sangeet and Sharmila have mentioned, in terms of too many problems at every level. That's one. And even for, say, the mature players like the likes of NTPC, which have not really gone through problems, very decent companies. I mean, the issue there is about growth, return on equity, return on capital, and so on and so forth. So, and the fact that, they have had sharp rallies in the last few days, well, my only observation on that is every sector in the economy or in the market over a 10-year period will have 1 or 2 quarters that will come back into favor, and then again be again out of favor and revert to the levels from where the rally started, if not supported by earnings growth and improved cash flows, improved return on capital, return on equity. And in power sector, I'm still not seeing that. If something positive happens and these rallies sustain, I may have a relook, but at least at this point of time, doesn't seem so. Now, one could say valuations are cheap, but then for those cheap valuations, I mean, what are the upside triggers in terms of growth? Well, I'm at a slight pain to find those So I would much rather focus on other sectors, there are enough other stocks which have also corrected and available at cheap valuations. I would just avoid this utilities sector overall.
Okay, that's the sense. Utilities is something that's more of an avoidable. JSW Energy is something that we spoke about in detail as far as this conversation is concerned, and it's the first day of the new financial year. No doubt it's April Fool first, which is also April Fool Day, but that's not something that we need. Vivek, which stock should one invest, for the year? And obviously you can't use the excuse if it doesn't work, it's April Fool.
No, absolutely not. In fact, in both these stocks, let me give an upfront disclaimer. I personally have investments as well as investments on behalf of clients. So it's like, if not you, my clients are going to pull me up, and my wife is going to pull me up for that. Okay. So I'm going to take a liberty of talking of two stocks. One is a rookie, the other is an established company. So the rookie is Reliance Capital, available at about 205. I mean, I think it's a deep value stock, market cap of 5,200 crores. I mean, they have a 43% stake in the Reliance Asset Management Company, which itself has a market cap of 13,000 crores. I mean, you take a 43% and assume some holding company discount. That itself covers up for the market cap of Reliance Capital, add to which they have holdings in Reliance Home Finance, Reliance Life Insurance and Reliance General Insurance, besides the core NBFC business which is in Reliance Capital itself, besides of course the other miscellaneous investments. Now, the problems in ADAG are well known, but what is important is that ADAG has clearly indicated intent to sell their businesses wherever they can find buyers. The easiest, relatively the easiest is sale of the mutual fund business RNAM to Nippon Life, which is also the 43% partner. 43 is held by Reliance Capital, 43 is held by Nippon Life, and Nippon Life is also a willing partner to perhaps pick up that stake. So generally we would talk about holding company discount. Here probably the deal between the two promoters could probably happen at a premium. So I'm willing to assume the entire value of RNAM without a holding company discount to Reliance Capital, and so that's one part of it. From a valuation point of view, on a consolidated book value of 570, I mean, it's trading at just 0.3 times price to book, where each of their businesses individually are profitable, whether it is the NBFC business, life insurance, general insurance, the asset management business, the home finance business, plus some other miscellaneous investments which also give them some other income. So over a period of time, the value unlocking and reversion in terms of valuations from 0.3 to perhaps one-time book, which is very conservative. I think, which is why I mentioned it's a rookie kind of an investment. High risk, high reward, but I'm willing to stick my neck out for a small part of the portfolio. The more mature one is Bajaj Auto, extremely positive on that at the price of 300. Most of their problems that they have had related to growth, whether it's the domestic business, whether it's the international business, seem to be behind it. They and double-digit growth in terms of sustained double-digit growth in earnings seem to be coming back. It's a very strong debt-free balance sheet, not just debt-free, surplus cash of almost 20,000 crores sitting there as of March 19. I mean, the year that just got over. And if we were to look at the valuations, I mean, enterprise value roughly of about 58,000 crores, and they would do an EBITDA of 5,500 crores next year. So we are talking of 10-11 times EV by EBITDA. Now, what is so great about this 10 times or 11 times EV by EBITDA? Last time it was trading at these kind of valuation numbers was during the global financial crisis, 2008, 2009. It was trading at 10 times EV by EBITDA, and that's what it has happened. The stock has been an underperformer for almost 5 years, while the earnings have kept growing. I mean, their free cash flows kept piling up on the balance sheet, and so on and so forth. So at 2,900, 3,000 levels that it is trading at, I see little downside, and possibly of the stock doubling in the next 3 to 4 years.
Okay, so the two stocks that were discussed, obviously Reliance Capital as well as Bajaj Auto. So that's something that Vivek spoke about. What about you, Sharmila?
Well, I'm not really, I'm playing it safe. Perhaps not so safe, given the way rupee is moving. But I'm going with an IT company and with HCL Tech, the larger IT companies. I think within its peer set, HCL Tech is trading at cheaper valuation. So I think that's a big plus. The kind of numbers that they gave, I think in a challenging environment, they've delivered good numbers. The kind of order wins that they've had, and their growth in various verticals. So I think that just because of this near-term election worry, risk, etc., And because market has really now sort of close to all-time highs, I'm playing it a little safe, and I'm going with a stock and a sector which I think can ride out both the uncertainties to a large extent. So HCL Tech from my end.
Okay, and Sangeet, what about you?
I've chosen DLF. So I think there's an interesting story which is brewing in DLF, which I don't think market participants are noticing. So DLF was sitting on a debt of 27,000 crores last year, and it is actually now going to be debt free. The promoters have infused close to about 12,000 crores. Basically, the entire sales consideration which they receive from sale of their DLF Cybercity stake. That's a big commitment to make for any promoter. With the QIP also done, I think the overhang on the stock is done with. If you see again the SOTP valuation for DLF, they have about 12,000 crores ready inventory. They have a land bank which I believe has a development potential earning of about 20,000 crores. The rental business is about 5,000 crores, and the value of the stake in they still own 66% in DLF Cybercity, which at the last deal which was done to GIC at about 36,000 enterprise value gives them a value of about 15,000 crores. Taken all this together, I think the total value comes to about 50,000 odd crores. And so there is about 20-25% upside, and with the another kicker from the RERA and GST being in favor of the organized companies, I think DLF looks safe a bit.
Okay, so that's the last stock that's been spoken about, the play from being a huge debt company to debt-free company, and the potential as far as their land bank is concerned. That's what Sangeet is betting on. But with that, it's a wrap on today's edition of Hot Money. Many thanks to all of my guests for coming in. Vivek, Sharmila, Sangeet, thank you so much for coming in. Ask BQ comes up next. Stay tuned to Bloomberg.